This is Daybreak Asia. We're counting down to Asia's major market opens. And Haidi, we're calling this week a central bank blitz. And I think it's pretty much nothing short of that when you've got the Fed, the BOJ, the RBA, just so many central bank decisions that are due over the coming days.
Central bank blitz, bonanza, frenzy. It is a treat if you are a central bank policy aficionado, certainly. There's a lot to follow, not to mention Indonesia as well as here in Australia with the RBA as well. Perhaps a little bit overshadowed by the big two, especially when it comes to the BOJ, right, Bell? And, you know, as we've been talking about, certainly corporate Japan have been positioning, even if it isn't this week, it's certainly a case of, you know, is it March or is it April?
Yeah, when you've got possibly the first hike or move away from negative rates that we've seen in Japan since 2007, I mean, it's no surprise that we're going to be really focusing in on what happens in Tokyo over the coming 2 days. That BOJ meeting is just kicking off, and already local media are pretty much reporting this as a foregone conclusion. Given the strength of the wage negotiations and the data that was reported on Friday, there is that expectation we're going to be hiking the key rate. Again, that exit away from negative policy settings. What does it mean, of course, for any sort of purchases of ETFs, REITs as well? That is going to be some of the other questions out of that session or that meeting. But here is the outlook that we have in the session so far today. We've got the Japanese yen holding fairly steady so far, but still pretty weak, around that 149 mark. And then equities, you are continuing to see those push higher, even though, of course, the dovish BOJ has been something that's propelled Japanese stocks. Still, there's a lot in the market that are saying there's plenty of other factors of why investors want to continue piling into this market. So you are just seeing the Nikkei 225 there, just a fraction under that 39,000 mark. Bloomberg Economics, that's just one of the economists to note here that's highlighting that perhaps the BOJ isn't ready to hike and they want to see even more data to sort of affirm their belief that we are starting to see strength in the Japanese economy. Let's change on. Just take a quick look at how Korea is starting to trade as well. Here, we are just seeing a bit of a slight bid for Korean equities. We did actually see net selling last week by foreign investors, but the Kospi, of course, one to track throughout the session today. And geopolitical headlines or risks also front and center here, because we actually had North Korea firing a suspected ballistic missile here as the U.S. Secretary of State Antony Blinken visited Seoul to take part in the Summit for Democracy. So we'll just check on those defense stocks in a few minutes from now, Haidi.
Yeah, let's take a look at how we're setting up when it comes to just got about an hour of trading under our belts here in Australia, and of course quite a bit of event risk, right, as we've been talking about. Specifically here, of course, we're watching the RBA. We're not expecting necessarily a major change from the RBA. A lot of the sort of domestic activity indicators have been trending in the wrong direction, so the RBA is widely expected to hold at that 12-year high for interest rates on Tuesday, particularly watching some concerns out of unemployment trends. They've been headed higher as well. But this is a picture as we see Australian stocks really declining. Miners are one of the big sort of heavyweights as we see iron ore continuing to languish under that $100 level. Some of the big miners, the likes of Fortescue in particular, leading those losses. But we're also seeing real estate as one of the laggards as well. Health shares are also dragging the broader sector lower, really following after we saw US stocks falling at the end of what has been a volatile week with that triple witching spurring a big jump in volumes as well. Aussie dollar sitting at 65.59. Of course, watching for any kind of indication that the greenback could burst out of its really range-bound trading actions that we've seen over the past few weeks. But of course, that iron ore price, some of those concerns about the China data that we're expecting a little bit later, also weighing on the Aussie dollar as well. This is a picture as we've seen Treasuries really starting to show some signs of caution in the market. This after we did towards the end of last week, 10 years on their first, the worst week, I should say, so far this year. We are still, though, seeing traders increasingly dying back bets on the pace, Bell, and the scope of easing expected from the Fed. And all of that has to do with the fact that we haven't seen a whole lot of communication from Fed Chair Powell in terms of, you know, definitively how he feels about the economy. We have had more definitive data, though, when it comes to how the Japanese economy, or at least these signals towards inflation and wage inflation, are trending.
Yeah, and we can get to some of those risks in perhaps calling out new features in the US economy that Jay Powell has sort of shied away from. But the direction of Treasury is also dependent perhaps in part on what the BOJ does. And as we've been just saying, local media is reporting that policymakers will end their negative interest rate policy on Tuesday. So let's cross over to Tokyo and our Chief North Asia correspondent, Stephen Engel. And Steve, as we said, pretty much a foregone conclusion in local media. But there are some risks present. So do we need perhaps another month to be sure of that strength that we're seeing in the Japanese economy?
Well, that's one of the big questions. Is like, why the hurry? Why the rush? And we just had essentially the former deputy BOJ governor, the right-hand man to the past governor, Kuroda, was right here with me just about 20 minutes ago and saying he asked that same question. Why the rush? Why not wait till April or beyond, where you get a little bit better picture and definitely more data, because the quarterly economic outlook comes out in April. And that was the consensus when I was here in January, when they decided to pause. Was that maybe April was the bigger, date on the calendar to circle, because you would have a wealth of information about the overall health of the Japanese economy. Yes, the Shunto, which is the annual wage negotiations, in particular on Friday when we got the Rengo, the largest, grouping of trade unions representing so much of corporate Japan, essentially in at least the initial wage negotiations agreed to a 5.28% increase in annual wages. That's far better than a year ago, which was already at a 30-year high of 3.8%. So that's something Governor Ueda wanted to see, and that is a sustainable, virtuous cycle of inflation, above that government target of 2%, backed by wage gains. So they got that. The fundamentals are there to exit the negative interest rate policy. But again, as the former deputy governor of the BOJ told me, essentially there's not enough strength yet, at least the data, to show that the economy can absorb tightening at this time. So essentially he was saying that the risks of tightening too quickly, too prematurely, outweighs the risk of overheating an economy which is in a fragile recovery.
Ueda has proven himself to be both nimble, but also he's refrained from any very clear messaging, right? So could we get more, perhaps, accommodative communications along with tightening?
Yeah, I think absolutely. He's going to be fairly dovish, and he is not going to essentially telegraph any future hikes as well. He does not want to go against what he's always been saying, and that is we are going to remain fairly accommodative. That's why we're likely, and most economists expect, to go along with this interest rate hike to exit negative rates. There will also be a commitment to basically be constant with its JGB bond purchases, essentially to show that despite the fact that we are exiting for the first time in 17 years the negative interest rate policy, we're going to remain a fairly accommodative policy with bond purchases. One thing that a lot of economists are saying, that perhaps they will back off on J-REITs and ETFs. Essentially, the stock market does not necessarily need the backstopping anymore. The ETF purchase program has been in place since 2010, so that could go away, as well as the negative interest rate policy. But bond purchases could keep going. And again, is this the foregone conclusion, what they're going to do tomorrow? Most likely, yes. Again, as I've been talking here to people, essentially the BOJ has already probably indicated to the government what they're going to do. And there's been some leaks, obviously, with Nikkei, Kyoto, Gigi, and everyone all reporting it almost as fact. So now we have to decide what will be next and what kind of guidance could we get from what will likely be a fairly dovish Governor Ueda tomorrow.
Stephen Engel is in Tokyo, our Chief North Asia correspondent, covering the Bank of Japan decision. What a monumental moment it is for that economy. And our next guest expects imminent action from the BOJ, given recent wage gains after nationwide negotiations. Ed Gomes is the CIO at SGMC Capital and joins us in our Singapore studio. Ed, great to have you with us. And I suppose the question is really, how impactful will this be on asset classes? Is it going to be a sell the news, buy the rumor, sell the news kind of situation, particularly when it comes to the yen? And does it have that pass through to equity markets?
I think when you're looking at the yen, you'd have to look at also the Fed, which we'll get to in a second. But the Bank of Japan, clearly is on the path to normalizing, and whether it's this meeting or next, it's almost almost going to happen. I think it's also, mildly hilarious, and we all need to recognize the fact that they've been in quantitative easing since, almost 2000. Like you mentioned, they've had negative rates for the last 17 years. They've been buying, ETFs for many, many years, maybe a decade now. So the fact that, they're eventually moving, while everyone else is contending with super high inflation, and even at this point in time, is something that everyone needs to think about in terms of, what exactly money is and, how it's priced. So having said that, if they move, we'd expect them to move, but also at the same time talk expectations down, so they don't want to have a runaway policy expectations of higher and higher rates. They'd want to push back against that. In terms of dollar yen, particularly, it also depends on how Powell handles the midweek meeting out of the U.S. And we don't expect too much of a change right now. We're still sticking with our call for about 3 cuts this year. Still enough time for that. But dollar yen will see initial reactions just based on the news. It's a very closely watched event, and everyone is going to be parsing the comments out of the BOJ.
Does this even momentarily derail the equity rally?
Out of Japan, I think it's momentous that we've crossed, even though it's been briefly, we've crossed over the 40,000 mark on the Nikkei, levels that were set 30 years ago. There could be a bit of a pause, but eventually, if as we expect, the BOJ talks down future expectations of hikes, you'll see, I think there's a fair amount of confidence in the economy for buyers to come back in.
There's the BOJ, of course, and then there's the Fed. Do you think that inflation data we've had recently, PPI, CPI, both coming in a little bit hotter than what economists had been predicting, do you think that tells us maybe we'll get a slightly different message from Jay Powell this week on rates?
I think he's going to want to, keep things on a fairly even keel. What we've focused on is the recent employment numbers, which came through last Friday or Friday before, where while the headline numbers were pretty decent, you also had the unemployment rate pick up, and you also had average hourly earnings tick down to about 0.1% for the month. It's normally been in the 0.2 to 0.3%. So while the annualized rate, the year-on-year rate didn't come down, the month-on-month, clearly there was some kind of softening. And to the extent that you're seeing that wage pressures in the U.S. on a bit of a back burner, you probably have some room for the Fed to eventually talk rates down. But we don't expect too much out of the meeting in March. I think heading into the next meeting in June is when you'd have some expectation of them trying to provide direction in terms of which way they're going to go. Keep in mind that in December, when the first time they said three cuts for this year, there's still ample time for that.
Something that really stood out to me in your notes is the question mark over what happens with the U.S. election this year, and perhaps a Trump presidency is coming into focus somewhat among investors, but you're not quite in that camp, it seems.
Not at this point of time. To the extent that polling is important, but it's not. It finally does not capture the mood on the ground. Right, and we're still about 6 to 7 months away from from the event, and there's going to be a lot that moves from here till then. But we've seen polling get many things completely wrong in the past as well. And what we're focused on is how the Biden presidency has rolled out policy over the last 3 years. The kind of manufacturing pickup, the kind of infrastructure spending, jobs getting created, not just at large corporations, but in smaller companies, in the small and medium enterprises across the country, and that's leading to what we're seeing, in terms of 4 key roles. It's really hard to find people to actually fill those roles. So when you see that kind of strength, in the economy, despite the fact that you now, after the Fed has hiked, over the last 12 to 18 months very significantly. The economy is not rolling over, right? Had we been in an era prior to the Fed hikes, and we had said the Fed is going to hike multiple times over the next 18 months, what would be the state of the economy? It wouldn't have been as robust as what we have right now. So all said, the economy is firing pretty well. Inflation is still sticky, so they do need to resolve that. It's never great for voters to be heading into the polls with inflation high. But overall, I don't think it's a done deal that Biden is not going to win. We'd keep our bets open for now.
All right, Ed Gomes, that was CIO there at SGMC Capital. And of course, it really is that focus on the health of different economies, and where we're seeing that weakness in China's one expressed this morning is really in the iron ore price, because we're continuing that drop below the $100 a tonne mark. And we have actually been keeping a watch on those mining stocks in turn as well. And you can see here, pretty mixed as we come online so far, but Fortescue really expressing that so far in the session. As I said, that watch on iron ore, that slump below the $100 a tonne mark. Let's switch on, because geopolitical headlines also one to track today, and you've got North Korea reports that it's fired ballistic missiles, or at least one suspected ballistic missile. It is sort of that show of force, because we had a visit to Seoul by the US Secretary of State Antony Blinken. He's taking part in a summit for democracy that's being held in the capital of Seoul. So just keeping an eye on some of those defence stocks, and we are just seeing those moving a little bit higher so far. We have as well seen Japan lodging a protest against North Korea over that launch, Heidi.
It is a busy, busy week for many, many reasons, Belle, and we will be getting some views on what we should be focusing our attention on and some of the risks and opportunities in China. Credit Agricole will be along with us next ahead of the release of key economic data. They'll be bringing us insights a little bit later on this hour. But first, a new Bloomberg survey sees Japanese money staying offshore once the Bank of Japan hikes rates. We get the details next. This is Bloomberg.
We've been saying that the Bank of Japan is very likely to be tightening policies.
My view is that it will be a very dovish exit.
Market split between a March and April exit from negative rates.
Japan raises interest rate, the US goes lower, the yen strengthens a little bit.
I don't think that they want to risk any financial instability.
The stock market has performed very well on the weaker yen, amongst others. So that could take a bit of the zest out of that.
Yes, there will be hiccups, and it seems that these couple of months would be a little bit rough for Japanese equities, but at the same time, they can give you opportunities.
The money then leaves Japan. Where does it go? That's the interesting one. And that could bring us back maybe to China.
There's some of the Bloomberg TV guests that we spoke to about our latest MLive poll survey. And one of the questions in that is, if we do see the BOJ hiking, and that's being reported as sort of a foregone conclusion in local media, is that going to trigger a flood of Japanese selling of overseas assets? And this result here is saying that there's a 40% chance of that happening. But the majority are saying that no, actually, there's more than $4 trillion that's being held offshore by Japanese investors, and perhaps it's going to stay that way. So let's bring in our senior Asia stock reporter, Hideyuki Sano. And Hideyuki, it's very curious, because if we do see a hike, it obviously makes Japanese assets more attractive. But why aren't investors so worried about that repatriation risk?
Hi there, Annabelle. I think the reason is quite simple. What the BOJ is going to do this time, what the BOJ's policy is quite complex, but when it comes to short-term interest rates, the BOJ is going to raise the benchmark overnight interest rate by 10 basis points this time to 0% to 0.1% from the current policy band of minus 0.1 to 0%. Now, if you look at the dollar's interest rates, it's more than 500 basis points. So what the BOJ is going to do is actually to shave just 10 basis points off that massive 530 or 40 basis points yield gap. And I guess most investors think that is not going to change the mindset of market players. And I can also point out the fact that even though the Japanese bond yield has risen quite a bit last year, Japanese investors kept buying foreign bonds. They bought something like a few trillion yen last year, and we haven't seen any change in their stance so far this year. So it seems reasonable to assume that just this 10 basis point rate hike is not going to change anything.
We're seeing the Nikkei now trading at a session high, and I do wonder, is there a sense that any kind of yen strength has been priced in already? What happens if we see another bout?
Yeah, that's a very interesting question, and I guess the yen's weakness has been a main driver of Japanese stocks. But on the other hand, a lot of investors are already expecting the yen to strengthen a little bit later this year. But then again, I think people who are worried about the yen's strengthening have the memory of what happened during the great financial crisis in 2008. And yes, at the time, the BOJ raised rates a couple of times, and a couple of years later, the yen strengthened almost by 50%. So if that happens, that's really worrying. But there are two key differences. And one is that Japanese investors now have a very high percentage of currency hedge on their bond investment. And that's completely different 15 years ago. So even if the yen strengthens, they don't need to sell US treasuries or US mortgage bonds because the yen is strengthening, because at least their currency portion is hedged. So I guess not many people are worried about yen's sharp strengthening at the moment.
I'm senior Asia stock reporter Hideyuki Sano. You can get more analysis from our expert editors on our Markets Live blog. That's at MLIV Go. This is Bloomberg. You're watching Daybreak Asia. Some of the latest political stories that we're tracking this hour. Vladimir Putin has secured another 6 years as Russia's president, winning more than 87% of support, with half of the votes counted. The 71-year-old will extend his near quarter-century of rule into a fifth term with his troops on the offensive in Ukraine. Three other candidates from parties loyal to the Kremlin offered no serious competition in the tightly controlled election. India has announced that general elections will be held over 6 weeks from April 19. The Election Commission says the 6-phase polls will be completed on June 1st, with vote counting on June 4th. Prime Minister Narendra Modi is bidding for a third term in office, boosted by a strong economy and a weakened opposition alliance that's been struggling to put across a cohesive message. Prime Minister Benjamin Netanyahu says Israel's military will begin operations in the southern Gaza city of Rafah within weeks. The US has described an assault on the city, which is sheltering an estimated 1.5 million Palestinian civilians, as a red line. Netanyahu also pushed back on calls for early elections, saying a vote would paralyse the country for 6 months and mean losing the war. Donald Trump says he would hit Chinese cars made in Mexico with a 100% tariff if re-elected, double what he had previously promised. The presumptive Republican presidential candidate addressed Chinese President Xi Jinping directly in a rally speech in Ohio. Trump has also previously proposed tariffs of as much as 60% on all Chinese goods and 10% on goods made anywhere else in the world, Belle.
And Heidi, just taking a quick look at how we're faring so far in the session. Lots of gains, in fact, every single sector in the green, but bank stocks are among those gaining today. Of course, that's a sector that does like rising rates, and that is what's being reported as sort of a foregone conclusion for the BOJ.
All right, we we are getting breaking news data when it comes to trade numbers out of Singapore at the moment. We're seeing for the month of February, non-oil domestic exports falling by 0.1%. That is a miss given that expectations were for a gain of 4.7%. When it comes to exports, we're also seeing that decline month on month. Again, I should say, of 4.8%. The estimate was for a contraction of 0.5%. Splitting it out, electronics seeing a rise of 5.2%. And this really, when it comes to the export-oriented economy, we are really seeing signs of some weakness depending on which country that you're seeing exports being driven to. For example, non-oil domestic exports to China seeing a decline of 0.1%. For other major markets like the US, we're actually seeing a gain of 17%. Weakness, though, for those headed to the EU, Belle.
Yeah, Heidi, such a big focus on so many different economies this week, but not least, of course, the US, where Fed Chair Jay Powell has been reluctant to make a call on how the US economy has changed since the pandemic. The Fed's economic projections for the long haul have also hardly changed since 2019, and investors are now growing frustrated over policymakers' lack of conviction. For more, let's bring in Jill Desis for some analysis on the big take. And Jill, we know that there are risks to calling out any sort of changes or new features in the US economy, not least politically, of course, as we're in the election year. But is that what's holding Jay Powell back at this point in time?
Yeah, it's interesting because I think what you're seeing here is a disconnect with what a lot of companies and a lot of investors are experiencing on the ground, where they're saying that this labor market resilience, this tightness that they're experiencing, seems like they're kind of settling in for the long haul, and they're seeing that sort of change in the overall economic picture. And of course, as you mentioned, we really haven't gotten that sort of really robust forecast update from the Fed in quite a while. I think at this point, traders are still pricing in something like a 3.5% longer-term Fed interest rate. That's about a percentage point up from where the Fed's actually at with its own longer-term interest rate projections, although obviously they'll have another opportunity to revisit that. At this point, you're right. Look, we're in the middle of an election year. I think anything that Jay Powell puts out there to the, to the broader public can be interpreted in one way or another based on whatever political leaning you have. And that's, obviously there's a lot of concern around that. But I think what we're seeing, again, from these traders and companies is that that absence of any sort of update right now is what's leading to a lot of uncertainty and a lot of volatility in the market.
And I suppose what's not helping, or I suppose I can also see why he's been like this, is sort of the lack of conviction and commentary that we've heard from Fed Chair Powell, right?
Yeah, I mean, look, at this point, it's a very tricky situation that the Fed is in, where, they've got this, we saw just a couple of years ago, some of those projections that ultimately led them to have to raise interest rates in this incredibly aggressive interest rate hiking cycle, highest in, many decades. I think at this point, there's a lot of confusion, or at least a lot of uncertainty over calling something before it's actually time to call it. So what you've been experiencing, what you've been hearing from Jay Powell and others in the Fed is that, they're still in this, we're still sort of observing what the, post-pandemic fallout actually is, what that impact is on the real economy and what that's going to be looking like going forward. I think it's very difficult to kind of, make a judgment call, especially because you don't want it to be the wrong judgment call. I mean, the central banks, in a sense, really kind of set that narrative for the broader economic trajectory. And it's, this massive responsibility, and you really kind of want to get it right. I think, what we've heard a lot out of Fed speak over certainly the last several months, not the last year or so, is this idea that they want to be patient and they kind of want to wait and see how all of these things are transmitting through the economy. And so I think that that's all kind of combining to see the, this kind of uncertainty that you're experiencing now.
Bloomberg's Jill Desis there with the latest on the Fed in what is a very, very busy week. And of course, kicking it off when it comes to the Bank of Japan. It's interesting the way that we're seeing Japan risk assets trending at the moment, suggesting that maybe a lot of this risk is starting to get priced in. We're certainly seeing some very hefty gains there for the Nikkei 225, 1.6% higher. The yen is really above that 149 level as well. So potentially, if we get a breakout after the Fed with the dollar, that might be a different question. But certainly, Japanese assets assets look pretty comfortable with the BOJ liftoff that is expected this week. We're also seeing the cost be up by just about 0.2% there. It's not just the BOJ or the Fed. We're also getting other central banks, including the Reserve Bank of Australia, a little bit more caution there with expectation that they will stay on hold, some of these concerns over recent data. But Aussie bonds, Bell, I should mention, opening the week lower, heading into a big week of risk.
Big week of risk and also big update on a lot of different economies. And we're going to get that for China later today as well, because we've got activity data that's due out in just a couple of hours here. If you take a look at the headline readings for industrial production, investment, retail sales, they're likely to show some growing or slowing, rather, growth rates from December. But let's get more insight with our next guest, because Credit Agricole's China economist Zhao Zheji is in the studio this morning. And when I took a look at what the consensus was expecting and what your team or you were expecting from Credit Agricole, you were a little bit away and perhaps a little bit more bearish on the outlook for China's economy in some parts. Is that right?
Yeah, I think the January and February data is unlikely to show any exciting news about very swift coming back of the economy so far this year. Our forecast is indeed showing this such a cautious view. I think overall we think the data will show a slower YY growth compared to last December. Largely it was because there is a very large difference in the comparison base. But beyond that, we think the underlying growth momentum may not be very different. I think we are seeing some of the stabilizing effect coming through after the policy easing. For example, the services consumption was quite strong during the Lunar New Year, but we are still seeing some of the warning signs. For example, property sector slump has continued. And if we look at the credit data from last Friday, it was not that great either. In particular, if we look at the household loans, the data there was quite worrying as well, because it shows that there could be some evidence of, the deleveraging effort from the household, while they could be quite concerned about their income growth. And also, if we look at the labor market, the youth unemployment is still a problem that the policymakers need to address.
Yeah, it's been something we've really tracked so closely, is that we've seen credit is available, but the uptick from corporates and households has been just so weak. So those numbers that we got out, plus what we're expecting today, how much does that tell you that we need to see more stimulus and also faster?
I think definitely there is room, and I think there is also willingness for the policymakers to step up their policy easing measures. We have seen a lot of policy documents coming from the National People's Congress, and also there has been following up measures. But so far, if we look at these policy packages, I would say it's still quite modest and is eyeing on the long-term, benefits of how to rebalancing the Chinese growth and also to foster the long-term productivities through those industrial policies. I think they will benefit in the longer term, but in the short term, I think the multiplier effect may not be that strong as compared to policymakers have a big focus on for example, on the demand side. But definitely, I think given where we are in terms of growth, where we are in terms of China's inflation, the policymakers will definitely do more, including from the PBOC side.
As we see from Japan, even on the cusp of liftoff, it's really hard to exit that deflationary mindset trap, right? Sentiment hasn't returned for Japanese households. Is China in that same situation? Is there a real risk of a deflationary mindset spiral? Is it already in that situation?
Thank you, Heidi. This is a very important question. So if we look at China's inflation, I would say there is still quite persistent disinflationary pressure in the economy, given the quite weak expectation and soft confidence. But if we look at the CPI, I would say that going forward in this rest of this year, I think CPI have likely returned to a positive territory, even though the reflation process could be rather mild. I think China's relatively low inflation and the recent disinflation pressure that we have seen is not just about China's soft demand, but if we look at there have been also the overcapacity issues in the manufacturing sector, and how the policymakers are carrying out their policy easing measures. Some of them may not be that reflationary either. So I think is an issue to be tackled, but with the policy easing measures coming through, and that will help, be felt by the overall economy, and will likely to help rather mild reflationary process in the rest of the year. I think is likely the CPI inflation will be in a positive range for the rest of this year.
All right, that was Xiaozhe Ji there. That was China economist at Credit Agricole joining us this morning in studio. Thanks for your time. And of course, let's discuss the market setup off the back of that sort of data that we're expecting later, and bring in our Asia equities reporter, Charlotte Yang. And we've seen sort of so much focus on China's economy. It's been just one of the factors that investors have tried to steer clear. But at the same time, we've got that focus on what's supposed to be the new economy as well. And that's sort of been this focus on renewables and materials and different parts of the economy. What's sort of the read-through now from investors?
Yeah, so I think a key thing people are watching today for renewables specifically is CATL. So the company battery maker just reported earnings on Friday, and remember that they had that big jump earlier this month, which helped push, the Chinex index, the one in onshore China tracking growth stocks. They had a big lift because of that. So earnings so far has been pretty positive on CATL's. The earnings are good, and also they surprised investors with that special dividend. So I think CATL is one thing to watch, and with more earnings coming up this week, with Tencent, Xiaomi, I think that will give us a broader assessments of whether this earnings season is as positive as the ones that have reported so far. So even with only 25% of say China reporting, so far they have beat aggregate expectation by 12% according to Bloomberg intelligence analysis. So I think on top of the China macro data we're watching, earnings is definitely a big thing this week.
All right, that was our Asia equities reporter Charlotte Yang there, and I'm really glad that you mentioned CATL as well, because we've got China pledging extra support for its EV sector as the EU moves to add more tariffs to imports. We'll have more on that story next. This is Bloomberg.
Well, China will take pragmatic measures to support the growth of the new energy vehicle industry. That's according to the head of the country's National Development and Reform Commission. The call comes as domestic EV makers gear up to report their latest quarterly earnings. The first will be Xpeng on Tuesday, BYD following the next week. And those results could provide better insight into the impact of the price war begun by Tesla and how that strategy will impact some of these other companies as well. Bloomberg's Linda Liu reports.
This is the BYD Atto 3, an EV that's popping up on the streets of Sydney, Berlin and Sao Paulo. And more Chinese EVs like it are being exported to the rest of the world. In fact, Chinese car makers now account for half of all global EV sales. They benefit from access to minerals and the cost-effective supply chain built over years. And from 2016 to 2019, Chinese car makers received $28 billion in government subsidies. That rebate program was phased out in 2022. So now China is entering a new stage of EV adoption.
The transition from a traditional ICE to new energy era is still unstoppable. So I think we're still very hopeful, it will bring a lot of growth opportunities for us.
Car makers want to make inroads in smaller towns and rural areas, but to do that, pricing is key. The competitive auto market is in the midst of a price war, started by Tesla 2 years ago, showing no sign of slowing down. BYD, XPeng, Geely and Leapmotor have all slashed prices to follow suit, raising questions over the sustainability of the strategy.
When you look at the intense price competition that you're seeing in China right now, that's not sustainable for any company.
The price war that's happening, it's a Game of Thrones price war, it's happening in Beijing.
The record deliveries don't always translate into bumper profit. When BYD overtook Tesla as the world's top EV seller last quarter, preliminary profits for the year were short of estimates by $500 million, and shares slumped. With the lack of government funding and a slowing domestic market, EV makers that do survive will have to come up with even better, cheaper products and sell to overseas buyers that may not be friendly to cars made in China. Linda Liu, Bloomberg News.
And that was some reporting there from our Asia transport reporter, Linda Liu, and she's joining us this morning in studio with our breaking news earnings specialist as well, Rachel Yeo, joining us here. Of course, for both of you, it's a very, very busy week for earnings across the course of these days. But Linda, let's kick it off because we just heard there about some of the risks and some of the things that we're watching for the EV sector in particular. So just give us a little bit more context on what we should be watching out for.
Yeah, so the market is going through very intense competition. You've got something like more than 100 players in the space, although that's going to decrease as domestic market slows and funding dries up. You've also got this intense price war that was started by Tesla 2 years ago, and now you've got companies like BYD that's continuing to slash prices. That's followed by rivals like Geely and Leapmotor. So it's a market that's looking very uncertain going forward for some of these players. XPeng, which is due to report earnings, is expected to widen its losses.
We're also expecting tech giants like Xiaomi and Huawei entering the EV race as well. So what does that potentially mean for this whole space and consumers?
The tech giants like Xiaomi and Huawei entering the space means that they're going to bring some of these very high-tech features that are only starting to come into EVs to the market. Huawei said that they want to be the best in advanced assisted driver systems, essentially giving self-driving features to some of these EVs. The leader previously has been XPeng, and they continue to really try to hold on to that lead. And you've got Xiaomi as well entering into the space. They're trying to bring this very sophisticated car ecosystem which can really link up with your phones to try to provide a seamless user experience. They're hoping that in such an intense market, their technology is going to stand out to customers and put them over other rivals like BYD that hasn't been so strong in developing these advanced technologies for the EVs.
And of course, there is that focus on tech, as we were just discussing there with Linda, but we've got a number of other tech companies, and Tencent is one of them this week. So what are we looking out for here?
Yeah, we are seeing a strong growth for Tencent this quarter. So this is supported by sales rebound in advertising, international games, and also fintech sales. They are also expected to see double-digit growth for their revenue this year as well. So in terms of their profit, Tencent's profit will also be further driven up by AI-enhanced ads as well as demand for short videos. This is also supported by cost control and also a stabilizing regulatory environment as well.
Rachel, when it comes to Meituan, we're expecting more cash to be returned?
Yes, Meituan is expecting to return more cash to shareholders later, and in terms of their earnings, they're expecting to see better growth as well after seeing success, expanding beyond the mainland in terms of, like, for example, having their meal delivery services expanded to Hong Kong, for example, which comes as China's consumer sentiment is waning as well. So Meituan is also expanded their revenue streamings sources as well, such as foraying into grocery retail. So we will see how that will play out in their upcoming earnings as well.
All right, very busy a couple of days ahead. We'll have more from both of you. I'm sure that was our breaking news earnings specialist, Rachel Yeo, there, and also our Asia transport reporter, Linda Liu. We'll have more ahead. This is Bloomberg.
Some of the latest corporate stories that we're following. Boeing's production delays are starting to hit airlines and their passengers due to the worsening shortage of single-aisle jets. United, Southwest and Ryanair are among carriers scrambling to deal with reduced deliveries as the plane maker focuses on quality control. Carriers say they're trimming schedules and looking for alternatives to the 737s they've already ordered. IKEA is planning to spend about $327 million in South Korea over the next 3 years to increase market share there. The Swedish furniture maker will open another so-called blue box store in Seoul and is considering many more smaller formats. IKEA currently has 4 outlets in South Korea.
Well, Japan's chief executives are preparing their businesses for the first rate hike, possibly since 2007, with the central bank widely expected to end its negative rate cycle as soon as tomorrow. Bloomberg's Haslinda Amin spoke with the Recruit CEO, Hisayuki Itakoba, to find out what a BOJ normalization could mean for business.
I think, the one big risk factor Japanese economy has is the really weak Japanese yen. So I think same as other central banks, it's just a matter of time how Japanese central bank is coming back to the normal situation.
Has business sentiment improved, do you think? Is finally seeing the kind of growth as we wanted to see?
Yeah, I think, what I'm hearing is finally Japanese companies can increase the prices of items, and that's the first step to increase the compensation and hourly wage. And that cycle, we have to definitely make it better. And so to do that, first of all, we need to increase the price on the items, especially importing goods, items, because of the weaker yen. Everything is becoming more expensive, but I think that's probably the first step to normalize Japanese inflation and economy.
Recruit Holdings CEO Hisayuki Itakoba there, and you can watch that full conversation in the next episode of Latitude with Haslinda Amin that premieres on March 28th. That is it for Daybreak Asia. Our markets coverage continues next.